Hello and welcome to a brand new show of Market Makers. Well, the election outcome is 2 weeks away, and that is something which is occupying everyone's mind. Whereas globally we can talk about trade war, volatility in crude, Fed change of stance, but frankly that's a narrative which may not really impact the market right now. The good thing here is that unlike the month of March and early April, the euphoria in the market is missing, and the kind of market positioning which we saw for ahead of elections in 2004 and 2014, that is missing. But what is the importance of election? How should one assess the slowdown in consumer and autos, and what about valuations and opportunity in this market? So let's talk about elections, valuations and much more on today's edition of Market Makers with Ravi Dharamshi. Ravi, fantastic to have you back. Thank you for joining us.
Thanks, Nikunj. Thanks for having me, and good morning to all your viewers.
It has to be elections.
Yes, can't avoid the topic for sure. But I think what is important from an investor's point of view is what are the cards that are being, the new government is going to be dealt with. If you see 2004 UPA 1 government was dealt a very extremely favorable macro scenario globally as well as domestically, and they reaped the benefits of that. And opposite was true for UPA 2. Where they actually came in post the global financial crisis, and we had a protracted slowdown because of that, and which has carried on till now. So for all practical purposes, it's been almost a decade of earnings lost. So in that kind of a backdrop, it is very important that whichever government comes in, it focuses on growth. Growth should be the primary objective. I think PM Modi was mentioning somewhere that last 5 years went towards meeting the needs of the poor, and next 5 years are going to be focusing on the aspirations, on their aspirations. If that is the case, then that gives me hope that, and if whichever government comes in, but if that is going to be the focus, the growth, then I think we should be hopeful more than despondent whichever government comes.
Before we talk about the 5-year agenda, let's talk about 23rd of May.
Sure.
Markets will swing.
Sure.
It could be 5% swing, it could be 10% swing. We don't know, but that is what history tells us.
Right.
What scenario to your mind is in the price?
I think the most likely scenario, like everybody keeps saying, is the return of NDA government, maybe with reduced number of seats. That is the base case that the government is, the market is playing with. But I think there is unlikely to be a major move if that is the outcome, unless there is a new government, and if there is a simple majority for the incumbent government, then and then only will the market movement will be exaggerated. Otherwise, I think we'll go back to focusing on the global backdrop and the domestic factors in a week's time from now, if the outcome happens to be the same as what market is expecting.
If the outcome is adverse, then what markets are betting on? Are we looking at a tsunami of selling, or the selling could be contained and muted?
No, as I mentioned earlier on, it's been 10 years of earnings slowdown, and I think in that kind of a scenario, and we have spent the last 5 years cleaning up the books, whether it is promoter at that level or government, forming regulations and framework to help the corporate India clean up their books. So if we are like probably more than halfway through in that cleanup, so I think going forward, whichever government comes, over a 5-year scenario, again it will be a beneficial thing only. I think we have a platform ready. We have billion consumers who are connected with mobile, and we have GST. Now we are one geography. We are the last standing consumer in the world. So everybody is looking at us with a lot of hope that we are going to take over the mantle of growth in the global economy when the two big giants are probably facing a slowdown. So in that kind of a scenario, I don't think one can be negative on the Indian economy and Indian markets for too long. So barring the initial reaction of the disappointment of the incumbent government not coming in, I think we'll go back to focusing on the factors, and I think there are lots of small positive changes which the market is not focusing on right now, and which will come into play. Also, right now the valuations optically seem high, but that is the top 25-30 stocks. If you look at the rest of the market, I think we are really at valuations which are like pre-2013. So and the world has changed, in my opinion, for the better. Crude is in a tolerable zone. rupee is stable, inflation rate is contained, and RBI is cutting rates. We are in a rate cut cycle. So in that kind of scenario, I don't see us dropping dramatically too much beyond the initial knee-jerk reaction.
How are you approaching the market right now? Election is one, which will occupy everyone's mind. But the concern is the slowdown in autos, consumers, because of NBFC and because of maybe a pure feel-good factor. You know, exactly a year ago, Ravi, when we spoke to Maruti, I heard the following from them. Demand itna hai ki car ka shortage hai. Now they're telling us that there is no demand and we are cutting up production. What is going on?
No, clearly, I think those are the more important factors than elections from the economy point of view. I think in my opinion, the consumption slowdown or the consumer slowdown is driven more by the NBFC crisis and less by Indian consumer facing some kind of a pinch, in my opinion. So, if the government, the stability comes back, political stability comes back, and okay, BS6 is a trigger down the line, so there might be some pre-buying for passenger vehicles and commercial vehicles. So that can again lead to a revival maybe sometime in the second half. So right now, even though it's looking dire, but I still feel it's a cyclical slowdown and not a very, very structural issue. And this slowdown is especially manifesting itself in EMI based products. That's my opinion. But I'll keep monitoring if whether that is
soap and shampoos are coming down. So that makes me just wonder that slowdown or no slowdown, EMI, no EMI, you don't stop having a bath or start rubbing a bar of soap. So
that is never the case. See, that's to do with the competitive intensity, or is it that the rural economy may be facing a little more issue right now. So there has been a lot of stimulus given. The pie is not shrinking, it is just the penetration of that category has reached a level where the growth is difficult from that level. So, and maybe there are some substitute products that have come in, for all we know. But having said that, I think rural economy has received a decent amount of stimulus, which is yet to play itself out. For example, this PM Kisan Yojana, the 2,000 rupees for thrice a year that is going to be given. I think 2 installments have already gone in. I think that can play a big role in reviving the rural sentiment. Then the farm loan waiver that has happened in the last 1 year. And also the fact that whichever new government comes in, the priority will be for them to revive the farm sector. So in that kind of a scenario, I feel even the rural revival is on the cusp. Maybe 6 months, 12 months down the line, we should have a revival. The cyclical slowdown will not prolong itself. That's my opinion.
So what are you doing in this market? Where are you shopping? Where are you getting out? Where are you realizing that the projections you had in terms of earnings or the management business ability to scale up, you got it wrong and it's now time to relook them?
So you are absolutely right. I think there have been very, very few places where one can find a clean story where the valuation as well as the tailwind is in your favor. So one of the things that we spoke about last time was the corporate bank, and I think that has played out to some extent.
It's the only thing which has played out for investors.
But I think it's still not over yet. The asset quality improvement that is going to drive the ROE still has some legs to go, and also the fact that credit growth is finally picking up. NBFC crisis is playing into the hands of the large private corporate banks who can actually buy these NBFC portfolios, and that's very easy growth for them. That's easy pickings for them. So I think some amount of realignment from NBFC back to the banks is going to happen. It's in progress and it is happening, and I think this trade will still last maybe 12 to 24 months going forward as well.
A lot of mid-cap stocks have sold off across the board, and the common theme here is not business, not demand, promoter pledges. Promoter have leveraged their personal capacity, and now there's a cash flow mismatch, and they are being forced to sell shares. Are you picking something which could be called as in distress, where the sell-off is technical, the sell-off is not fundamental?
Okay, so in a perverse way, actually this is a very bullish sign for me. Usually these are the time, this happens in the late stage of the cycle. I mean, yeah. So who are the sellers? Either it's the lender that is selling, or it is liquidation happening, or desperate promoters selling, or trying to get some asset value out of their asset to repay their lenders. So all these are desperate sellers, and to some extent maybe there are retail investors who are tired of not getting any kind of returns for the last 18-24 months, and their patience is wearing thin, and that is actually giving rise to an opportunity. Coming to your question, have we picked any such distress asset? No, we have not, but we are constantly and continuously monitoring. We will wait for the opportunity where we feel the asset value is dramatically more than whatever the market is reflecting right now. You are absolutely right, it's a area that we should be focusing on, but we have not picked up anything as of now.
Would you buy autos in this sell-off, or would you buy consumers in this sell-off? Because a stock like iShares is down from 35,000 to 23,000, and HUL is down 15-17% from its recent high.
If you put a gun to my head and I have to choose only between the two of them, I might actually not choose either of the two.
Oh, you'll not buy autos also?
Yes, I would rather go for more secular stories than a cyclical one. But having said that, maybe 3 months, 6 months down the line, with some price correction, I am not averse to looking at auto. But consumer stocks like lever, I mean, I've definitely, valuations are more expensive. But I mean, lever is an example. There are other companies within the FMCG pack where you can probably look at. I mean, there is a large tobacco company which is available at much cheaper valuation. I mean, we have to see whether the factors are turning out in favor over there or no. I think that's, you can pick and choose within the sector. You don't need to go with necessarily the most expensive stock.
Are you buying risk or growth in your portfolio, or it's time to now take a safety shelter kind of an approach, stick to stocks where you may not lose too much?
See, growth is not visible in most of the companies at this point of time. So unfortunately, at this point of time, you have to go with the quality of the company and the valuations, and you have to pick the company or the stock where you believe that come what may, they will not make cardinal mistake of over leveraging or something, or ending up doing capex at the wrong time of the cycle. And if market has punished them for the slowdown in the growth and all, growth I feel is a temporary thing. It's the more balance sheet issues that cannot be resolved very easily. So if the problems are of P&L, I'm more open to buying them. But if the problems are of balance sheet, then I'm still a little wary of picking them up right now.
This is the third or the fourth year, I would say actually fourth year, where earning estimates are going to be downgraded.
No, I think it's 8th or 9th year.
I mean, the optimism had come back 4 years ago.
It's 8 or 9 years since estimates have been downgraded.
Okay, so what does one do now?
Don't stop estimating first of all, because you are not getting it right at all. No, I think having said that, this year I feel I think the estimates would be around 25% earnings growth. Even if we do not end up showing a 25% kind of growth, I think we'll end up showing somewhere close to 18-20% kind of growth, which is good. It's not a bad year. Having said that, I think what matters more is the quality of earnings growth. If it's just a mathematical increase in earnings because you have provided less, that doesn't excite me. I mean, most of the earnings growth is going to come from the banks which have gone through the provision cycle, and their provisions are tapering off, and that is leading to a increase in profits. But if that is the only reason, then I would be a little wary of the earnings cycle rebound. I'm looking more for where the growth is panning out, where some operating leverage is coming in, and that is leading to an ROE improvement. I think those kind of stories would attract me more.
But are there enough options like this, where growth, valuation, operating leverage or financial leverage, they can work together?
See, I think in our conversations in the past, you keep mentioning that good headlines and good valuations don't go together. So right now we are in a situation where there is bad headlines, and along with that is coming good valuations. So the valuations and the quality of company remains the core that you have to be focused on at this point of time, because you will not have the growth visibility. You have to focus that on the broad opportunity, and believe that whatever the slowdown is happening is temporary in nature. And if your horizon is beyond 1-2 years, then I think those companies will provide you with fantastic returns over a 3 to 5 year horizon, if you pick the right company with a management and valuation perspective.
It's still long specialty chemicals, long diagnostics?
Yeah, so I think those companies are facing fantastic tailwinds. I think there is, thanks to Mr. Trump, there's a global realignment of supply chain that is happening, and India stands to benefit because of that. And chemical slash API intermediate pharma companies also will benefit because of that. China happens to be like 40% supplier to the world of the APIs and intermediates and chemicals. So this kind of a market share is definitely going to come down. Maybe it comes down by 5% or 10% over the next 5-10 year period. And which are the countries that are eligible to replace that that kind of market share? I think India is definitely up there. We have the scale, we have the manpower, we have the entrepreneurs, and so we need to just grab that opportunity. And I think that this opportunity will last some more time. I mean, I can see it lasting at least 5 years to 10 years.
Where are you taking a deep breath and assessing that, look, I have worked with an assumption. See, markets are all about making scenarios. There is nothing like a 100% foolproof investing. Risk is associated with best of the investments. Where are you saying that, look, my assessments, my assumption, my earning projections have got challenged? It could be the management risk, or it could be a business risk. And you said, look, I need to move on.
Yeah. No, so moving on is a secondary thing, but definitely where I feel one story that was hyped a lot was this shift from unorganized to organized. Now that shift actually might happen now going forward. I am not giving up on that story, but definitely there has been a couple of years delay in that story panning out, because what happened is
excepting Titan, I don't see evidence of that anywhere. Let me put it this way.
Absolutely. And e-way bill, for example, was supposed to be implemented. That got delayed. The compliance with that is still a little lax. And in fact, in the meantime, what happened is the unorganized actually got a super advantage, because their costing was cheaper and they didn't even have to comply. So that led to the organized guys losing out a little bit in some of the industries like building materials and all that. Going forward, this might change. So I have not given up on that opportunity. I think there's just been a delay of a couple of years. But and if you can find a company that caters to that opportunity, I think instead of giving up now, one should be focused on placing a bet on that with a 3 to 5 years point of view. And for all you know, next 6 months can still be bad. You have to have that assumption in your the main, for example, if I take building materials, the main plank of the growth is real estate, and that real estate isn't reviving as of now. So you cannot be making growth assumptions which are way beyond what the market is. It is not easy even for the leader to be growing at that rate.
What will you not buy in this fall?
We continue to not like cyclicals, and especially global cyclicals.
So no metals?
Metals, I mean, it's more because our understanding on that front is a little poor, rather than I have a strong view that one should avoid metals or something like that. No, it's just that we don't, the predictability of the global factors of the global cycle, in my opinion, is very, very poor, and we don't have any expertise in that. And what we had from 2003 to 2008 was the global super cycle where the metals went through the roof. That kind of a situation coming back again looks very, very difficult to me, because China is tapped out on the infra front, and I don't see anybody else picking up the gauntlet. I don't think India can replace China. So I would rather focus on the domestic themes in the terms of consumption, or I can think of where India is going to replace China in the global supply chain. I think I'm more keen on playing those kind of stories.
Is the bull market in mid and small caps over? Because
it's been over since I think 1.5 years now.
Is it
we
over?
are in a bear market.
We're in a bear market. Will this bear market continue for 2 years?
I would doubt that. Historically, if you see on a rolling 3-year basis, I think the valuations would have reached a real bottom, except for global financial crisis in 2008. I think we are at the cheapest we have been in the last 2 decades. I think probably even cheaper than 2001-2, but my memory fails me over here. I don't recollect exactly. So in that kind of a situation, I find it very, very difficult to be bearish on the large part of the market. So when we last spoke, I think I mentioned that we'll be going completely invested into the elections. I think nothing changes on that front, because even though FII flow started coming in, and that money, ETF money, went more towards the larger companies and index companies, the large part of the market, the breadth still remains weak. And I think that that gap has widened even more. So I think that gap has to narrow over the next 2-3 years. So one large theme, if nothing else, if people have missed out on investing in mid cap, small cap, I think this would be a good time to be allocating towards mid cap, small cap focused fund with a 3-year point of view. I can never say that it's going to bottom out in 1 month, 3 months, or 6 months. So, but the valuations are getting really, really cheap, and I think the jaw needs to narrow.
Okay. What are the chances that mid cap stay where they are, but large caps they start coming down?
Possible. That is also possible. So right now the all the factors that the indicators that we track are all pointing to a slowdown, whether it is globally or locally. So one can never rule out that first leg is going to be down, and if for whatever reason election outcome isn't what the market expected, then that will provide even more reason for the stocks to get cheap. So that remains a possibility and that remains a scenario, but one cannot prepare for it, in my opinion. One cannot. So if you actually go, liquidate your portfolio, go into the election, and if the opposite is true, then you will not get these kind of valuations also, in my opinion.
So just if you have to really summarize today's interaction, can I say that from a market standpoint, election is important, it is crucial, but from a price adjustment standpoint, it's a 5 to 10% event, nothing more than that.
I absolutely feel so. I think it will not be a 20% kind of a move that we have seen in 2000, where it comes out as an absolute shocker that this whatever the incumbent government lost and we had a 20% drawdown. I don't think that will happen. We are not positioned that way mentally as well as in our market positions. People are cautious, people are wary, people are suffering because of economic pain. So the decisions have been more to get their house in order rather to go overboard with optimism. I don't think there is any optimism left for. So in that kind of a scenario, a negative event will not have a prolonged impact.
Okay. So corporate banks you like, pharma selectively you're still bullish on, you like within consumers some tobacco dominated names?
I think we are going to be spoiled for choice if actually a negative event pans out. I think there are lots of spaces in the market where the valuations are getting really, really attractive.
What is on your radar?
I will not name companies, but as I mentioned, some of the themes are the global realignment of supply chain, maybe now a delayed pickup in the theme of unorganized to organized, and some adjustment in the financials from NBFCs to banks, and maybe even the PSUs become really cheap. I mean, at this point of time, they are just about factoring in survival. A little bit of growth coming back will also help them. So, but that's a trade for us. I mean, we have never invested in any PSU company. So we like to focus on companies that have some competitive advantage, and I think PSUs are losing competitive advantage by the day.
Ravi, when we had the option to plan this interview, the choice was that we could have easily planned after election.
Yeah.
The fact that you've come and you've spoken about the market positioning ahead of election speaks a lot about your thought process, because after election, with the clarity coming out, you can easily give a very
it's very
judgmental
easy.
view.
It's
so I'm glad
how you position today is going to be crucial to my portfolio. And honestly, there is, and I have to think beyond the immediate impact of the election results. We have to think of 3 months, 6 months, 12 months down the line. And when you think of that, I think only you cannot control the election outcome. You cannot even control how the market will react to that election outcome. Only thing you can control is your behavior. And I think keeping your head is going to be more important amongst whatever chaos that is going to happen. So rather than getting, even if election result is favorable and markets go berserk, I think one needs to be still careful that it's not necessary that economic data is going to start churning out positive immediately.
That's what we've realized after 2014, that it takes time for a cycle to pick up. So really appreciate your time. I wish next time when we meet, there is much more optimism in your voice. If I have to do a dipstick right now, what you are telling me is the sense on the street. Everybody either is cautious or they are bearish. Some are feeling scared, but that's how typically bear markets bottom out.
Very, very, very difficult for anybody to be optimistic at this point of time, I feel.
When the diehard bull gets pessimistic, I just...
I'm not pessimistic. I'm just saying I'm a contrarian positive because there is nobody left who's optimistic.
Appreciate that. That's how typically markets bottom. But appreciate your time. Thank
All
you
right,
for
thank you so
joining
much.
us. So that's it on this edition of Market Makers. Thank you for tuning in and thank you for watching the show.